Oil moved higher, but markets did not fall. According to Reuters, tensions in the Middle East pushed oil higher during the session, but prices failed to hold those levels and pulled back into the close. At the same time, the tone from Donald Trump continues to limit worst-case pricing, as his previous comments did not completely rule out indirect talks with Iran. And here is the key part. As oil pulled back, bond yields moved lower, the dollar weakened, and equities moved higher. This suggests that the market may have already priced the war risk in advance. So if the risk is already priced, what is the market waiting for now? Global markets today reacted differently than expected, as oil moved but did not trigger a broad risk-off move. According to Reuters, oil moved higher during the day due to geopolitical tensions, but the move failed to hold and prices pulled back into the close. This suggests that markets are no longer pricing new risk, but rather adjusting to a risk that may have already been priced earlier. While there was no new direct statement, the tone from Donald Trump continues to shape expectations, as the possibility of indirect engagement with Iran remains open. This kept oil from sustaining a strong rally and reflects a shift in risk perception rather than just a technical move. This dynamic also spread across markets. As oil pulled back, inflation pressure eased, US 10-year yields declined, and the dollar weakened. This combination supported risk assets and led to stronger buying into the final hours of trading. By the close, US indices finished positive, with a notable recovery in technology stocks, showing that the market is not fully risk-off, but rather buying dips. In sectors, technology stocks recovered after early selling, energy stocks followed oil volatility, and defense stocks remained strong due to geopolitical risk. Gold told a different story. Despite the pullback in oil, gold moved higher, suggesting that investors are hedging rather than panicking. So the market is not afraid, but it is not fully comfortable either. The main driver of the rally over the past 2 days has been signals that the US could exit the Iran conflict within 2 to 3 weeks, which markets interpreted as a potential de-escalation scenario. At the same time, Brent crude declined from around $118 to nearly $102, reinforcing the perception that the worst-case energy shock scenario may be easing. This became the key catalyst behind the equity rally. Reuters and AP directly link the global equity gains to these de-escalation expectations and the pullback in oil prices. Is the rally concentrated in a few large stocks, or is it broad-based? If sectors beyond defense and banking, such as airlines, industrials, and technology, are also participating, this signals a healthier market relief. According to Reuters and AP, the recent rally has been notably broad-based. However, markets are currently pricing in a scenario where a lasting supply shock may not materialize. If this assumption breaks, the outlook could shift rapidly. Reuters and AP emphasize that risks around the Strait of Hormuz remain firmly on the table. Musalem's remarks are also critical. The Fed remains cautious and continues to take energy-driven inflation risks seriously. This means that if oil prices surge again, the pressure on equity markets could intensify. Looking at crypto, the picture is weaker. In such environments, crypto usually reacts first to liquidity, but today it failed to show strong upside even as gold moved higher. Bitcoin traded in a narrow range around $66,000, while Ethereum held above $2,000 but failed to attract strong buying. Total crypto market cap remained flat, with limited volume and activity concentrated in Bitcoin and Ethereum, while altcoins stayed weak. This tells us one thing. The market has priced the war, but is not ready to take new risk yet. This is not a panic market, this is a transition phase. Overall, markets are balancing between oil, rates, and geopolitical developments, and unless there is a clear shift in this balance, both equities and crypto are likely to remain volatile with a mild upward bias. We talk markets, not noise, D&D.